I'd like to introduce Clinton Arentz. Clinton has over 20 years experience in asset management, property development, and project lending. Prior to joining Trilogy Funds, he provided project structuring and development directory services on commercial, industrial, and residential projects in Brisbane, regional Queensland, and the Northern Territory. An experienced company director, Clinton has extensive property background and enjoys a wide industry network and deep market knowledge. In particular, he has start to finish project delivery experience in medium density residential, commercial, and industrial new development and repositioning, as well as urban renewal and urban infill projects. As the head of lending, Clinton leads a dynamic and broadly skilled property lending team at Trilogy Funds Management and oversees sourcing, structuring, and management of all new lending opportunities from inception to completion. Trilogy lends on residential, commercial, retail, and industrial development projects here in Queensland, New South Wales, and Victoria. Trilogy Funds also operates managed investment trusts, holding assets across mortgages, direct real property, and other financial assets on behalf of over 14,000 investors. Clinton also assists in acquisitions and project delivery for Trilogy's property unit. When acting on behalf of their clients, and the Trilogy team utilize their extensive understanding of finance and funding to acquire completed stock or sites on which to develop commercial, industrial, childcare, specialist medical, and NDIS projects around Australia. So welcome, Clinton. Quite the intro there.
It was quite the intro. Thanks, Julian.
So we'll jump straight in, Clinton. I mean, as someone with your depth of industry experience, I mean, how has lending or the lending industry changed and innovated over the past, say, 5 years?
Well, it's a good one to start with, Julian. It's quite remarkable, the change. And having been in the property industry, I guess, as you probably well articulated, for over 30 years, I think that change is accelerating, becoming more rapid, certainly with the arrival of new technology, most definitely. So, but look, for all sorts of reasons, markets are very dynamic and constantly changing. Liquidity levels rise and fall, risk appetite rises and falls, and the players in the market seem to sort of shift in and out a little as well. So there's consistent long-term industry stalwarts, if you like, but there's often new players coming into the market as well, offering products and services, but of course also getting behind development projects as well. So we see constant innovation, and that's likely to increase over time as new technology emerges.
Yeah, definitely. There's a lot of tech hitting the market at the moment. So, I mean, working with you guys and the broader Trilogy team, you guys seem to be ahead of the curve in terms of tech adoption. Can you sort of explain what has been implemented and within the sort of the business and why?
Well, it's in the company's DNA, I guess, to be innovative as well as agile, most importantly. So from our perspective, we want to be ahead of the market as much as we can, because we do provide a service and a product. The service comes via our portfolio managers and investor relations folks, but the product is of course construction finance. And both of those areas are highly competitive, and so we not only feel like we need to be good at our game as individuals, but we need to have the technology and the levels of support that enable us to give our clients a competitive advantage.
Yeah, I think that competitive advantage is so important, because at the moment it looks like the landscape of non-bank lenders is just growing, obviously on the back of the hot market. So, I mean, what is your overview of the sort of the current market and the competitive landscape, especially in that non-bank sector?
Well, it's probably important to start with the concept that Trilogy was formed over 2 decades ago, and has grown through multiple cycles consistently over 20 to 23 years now. So we've seen it all before in that sense. As a company, we understand these cycles quite well. We've got huge depth of experience on our board and in our lending committee, which is a great guiding influence for us. But at the other end of the scale, we've got lots of bright young people here in IT and innovating in a number of ways. But we're a large pooled mortgage fund. Recently, we celebrated over 5 100 million under management in construction loans alone, let alone the other funds management areas we're involved with, like our industrial trust and our single asset trust. So, so we're $500 million funds under management just in construction lending, and approximately 100 loans across the east coast of Australia. So we're large, we're well diversified, and we're quite experienced. But most importantly, we're agile. So we're constantly moving with the trends as well, both in a technological sense, but also just understanding where the markets are at. So I would say that there's not that many large non-bank players. What we've actually seen happen is, since the Banking Royal Commission and other areas, I guess, that have put pressure on the four primary banks, if you like, to some extent, they've stepped back from that construction lending space. But we were always there. That was our base level business right from, as I said, 2 decades ago. So we've continued to lend and grow our business model through these ups and downs of other industry players. And of course, the large-scale banking sector seems to be well out of the construction space at the moment. They don't seem to have much appetite for that at all. And they have their own prudential reasons why that would be the case. But it is our line of business. That is what we do. And I guess what you're talking about by other non-bank lenders emerging is there's lots of private groups and smaller players, lots of contributory funds that just raise money on a case-by-case, loan-by-loan, sometimes drawdown by drawdown basis. And they're in the market space, and prima facie, they might look attractive at first glance. But if you dig a little deeper, you'll ask, do they have a construction facility that enables the orderly management of progress draws? Do they have the availability of funds as and when required? Do they have that pool of liquidity that comes from a pooled mortgage fund, which is, it's a much larger, more complicated structure in the sense that, we've built all of these mechanisms over time. It's not opportunistic. It's not related to the current cycle. It's not new hot money that's emerged over the last 6 to 12 months, literally. I mean, it seems that, there's been liquidity stored up through the COVID period that is to some extent being unleashed around the world now in Western world economies. But that can be hot and cold, and some of those funds can be there 1 minute and gone the next. That's not the stable part of the market. The stable part of the market is what we do, and other larger non-bank lenders that make a business out of doing this, not just treat it as a one-off opportunity here and there, because you're subject to their personal whims at that point, which might look attractive, as I said, at the start of a project, but sometimes becomes a lot tougher for the borrowers at the back end of that transaction as things are starting to play out on site or through the sell down program.
Gotcha. Okay, so I mean, the title of today's talk is areas where lenders see risk and how developers can overcome this to get the best possible terms for their project. So for the developers that are on the line right now and want to get your perspective, broadly speaking, how should they go about doing this?
Well, if we start at the base principle that we have available funds, we're a great company to reach out to, because the availability of those funds through the pooled mortgage approach I mentioned, also matched with sort of dedicated portfolio managers at quite senior level across Brisbane, Sydney and Melbourne that service not only those capital cities, but the states as well in terms of the key regional areas. We've got that personalised service at that level. So a developer in Melbourne will get the same level of service from us as a developer in Brisbane or Sydney might, or in those key regional markets, as I mentioned. So that's a key element for us, I guess. And borrowers or developer clients can actually leverage off that to some extent, because we have a body of knowledge in terms of how the markets are performing. So we can help guide the projects to some extent. It's not interventionist in any way. It's more at an assistance level, but it's not like we're going into a lending arrangement without a full body of knowledge. The level of research we do to set a loan, even before the loan's approved, is a very high level of research, which we're constantly looking to access that market knowledge and data. So we source that from numerous sources, in particular quantity surveyors and valuers or primary consultants that would be engaged in all of our projects. But that other depth of market research that talks about sales analysis and sales rates and rates per metre in selling, as well as constructing, all of those are critical elements that we're constantly seeking out and using to calibrate our judgment about whether the project makes sense or not, and should we support it.
So maybe you've answered my next question there. So it was more specifically what Trilogy pays a lot of attention to when it comes to key credit risks and strengths, for that matter. Is there anything in particular that you guys sort of hone in on that might be a big red flag if found?
Oh yeah, there's probably lots of those. But look, in the normal course, what we're looking for is good quality, what we describe as sponsors, project sponsors and stakeholders. So there might be the borrower group, and often they're multiple parties. There might be more than one group that come together to execute a specific project. So to some extent, you want to back the key people, the stakeholders in that project. So you need to understand their vision and to some extent share their vision for their project in that sense. So we obviously look at the quality of the sponsor group, if you like. So now they don't necessarily need to be ultimately experienced like Harry Triguboff or Lang Walker. They're not necessarily needing to be at that level. Often they're people that have a great site, they have terrific business acumen, they've heavily researched their project, they've got a strong project plan or business plan around the project, they're well capitalised, they've got probably a fixed price building contract, or at least indications around a construction cost element. They've also got very clear timelines, understanding how the approvals process will work, both at the front of the project, getting your original approvals, and at the back end of the project, getting your final certification signed off by the multiple parties that are involved. So project programming and timelines are critical for us. Sponsor strength is critical for us. The design of the project is something we look at to make sure it might be a great site, and it might be great people, but if you've got a poor quality design, the project will still ultimately struggle. So all these things need to be looked at. As I mentioned earlier, rate of sales in the market, very detailed valuation support. So we're looking for those as strengths. Now, weaknesses would almost be the opposite of that, or the corollary of that in that sense. So weakness would be, poorly made project plan, inexperienced sponsors who haven't properly thought it through, not all the approvals in place, which means you've got both time risk and cost risk, seeking to get those approvals. And there's almost infinite variables where new players or inexperienced players can fumble and ultimately miss completely if they're not careful. So we don't take the place of their decision making or investigations. They have to make their own arrangements to get to that point. But we're looking for a properly made submission, the one that's well thought out with regard to those elements I've just mentioned. And that leads us, of course, to building relationships with those groups that ultimately could become repeat clients. And we have a lot of those groups on our books, and we very much encourage that. So the levels of performance and reporting and assistance that we give during the project, and particularly on the construction draws, it helps sort of bind everybody together as a working team in a collaborative partnership type approach, which sort of harks back to what I was mentioning earlier about some of the hot money that's arrived into the lending space recently. Might take a very different view on that, or have no view at all. They're not there to provide that level of assistance or that level of scrutiny or that level of control that we most certainly do. In terms of the key variables of construction costs and timing and project execution, which we're very much across on a day-to-day basis for every one of our projects.
Yeah, and property's always been sort of told as a relationship business, and you mentioned it there. Forming strong relationships is very important, and maybe that probably is the answer to the next question, which is some of the key credit enhancement strategies that developers can deploy. Well,
to reinforce those elements, I guess, and it's interesting that the conversation's free flowing, but we sort of come back to these key points because ultimately, while there's so much innovation and so much change in the industry, the core principles have remained the same. Certainly, in my observation of the industry, and even reading case history going back over the last 100 years or so. There's some fundamental elements that are really important. So if you can strengthen up the project in those key areas of the cost base, the timing, and the exit strategy, and the realisable value. If you've got those key metrics and you've got the right skill sets in each of those areas, so that you've got the right selling agents and you've got the right builder and you've got the right architects and the right town planners that give you the best opportunity to have that project of yours become successful. Once you start cutting corners, and that's often the temptation for less experienced players, you start to cut corners and use cheaper trades or use a flimsy sort of a design solution or construction solution. Invariably, you're inviting troubles later. It's a false economy. It looks attractive up front because you go, well, look, I made extra margin in my project. But of course, you've got to realise that margin by delivering the project, and it's not until everything comes home to roost, including the final sales, and ultimately at some point we get repaid. That's when you've had a successful project. And the experienced parties tend to be very vigilant around that. So they also have an eye for detail and a level of scrutiny, which tends to support their day-to-day activities, and they basically create their own success at the front end by setting up the right structure. And we very much argue part of that structure is the right funding solution. So I would say that's obviously a clear pitch for Trilogy, because we try to provide that funding solution and that level of support and that collaborative approach. And we're quite happy to say, look, no, we can't support the project. It doesn't make sense to us, or it doesn't fit our criteria. And we do a lot more of that than we do of approving projects, because a lot of them come in that are not completely made in that sense. They haven't got all of the puzzle solved, and therefore there's a risk element that can't be quantified and measured and managed, and without understanding how to manage that, that's a no-go area for us. So I think that probably answers your question there, Julian.
Yeah, no, definitely. I mean, focusing a little bit more maybe on the operational side, or Trilogy more specifically, for you guys, and you mentioned it there, like, I mean, what are some of the key ratios that you guys lend to? The LVRs, minimum maximum loan amounts, pre-sales, what you're sort of looking at from that perspective, approval times that you guys sort of work with?
Yeah, well, let's unpack that a bit, because there's a couple of key elements there. So the approval times will be driven by how properly made the original application is. So we can only work off the information we've got. And so, products like yours, for example, Aprao, I mean, they give to us a working model that we can then absorb into our modelling internally and our assessment process. And a lot of the bases are covered, and a lot of the knowledge is already there. And all of that back of house, which so well, is all complete in that one format, that one platform. So that'll accelerate approval programs exponentially from our side, because otherwise we've got to go back with basically requests for more information. And to the extent that the developer group is able to provide that, it either continues the path of a satisfactory outcome and a loan approval at some point, or it doesn't, because they actually don't have the answers to those questions. And so they go back to the drawing board and start working on that. So approval times are very much linked to the quality of the original submission in that sense. Key metrics, once again, that area we were talking about before with respect to some of the long-term fundamentals. I mean, we find we lend up to about 60 to 65% of the gross realisable value, that'll be tested by a current day valuation report from one of our panel valuers, which we have seeded up and down the East Coast effectively, and mostly in the capital cities, but we will get direct access to current valuation, which we'll actually instruct. So we'll make sure that all of the key metrics are covered in the valuation, as well as instruct a QS to prepare a quantity surveyor's report, so we can cross-check all of the pricing and make sure that not only is the design right, but the cost base is right as well. So on that basis, we'll end up to about 60% of end value, maybe 65% of gross realisable value. And we look at it as an asset on completion, hence the nature of the valuation approach, which is an on-completion valuation. And so by doing that, I guess it sort of narrows down what else we can actually agree to in that sense. So the pricing is market driven to some extent, so we tend to be agile around pricing and flexible to the extent that we need to be in the market range, but we're not pretending to offer a flimsy package. You know, we want to offer that level of support we've just talked about. So on that basis, we need to price it accordingly. So the pricing is basically market set, but within our range. And we're not pre-sales focused because of this end approach of asset value. We look at the end asset value and you would say, well, if we've got all those things we talked about, proper exit strategy, a good design, the right marketing agents, and a strong sponsor, we take the view that there will be a sell down rate, and we interrogate that and monitor that as we go forward. But on the basis of that sell down rate during the project, then we're not necessarily inclined to require pre-sales. And that's a critical point for developer clients, because in various markets, and I travel to each of them, Sydney and Melbourne regularly. I'm based in Brisbane, so we sort of scan the market at a personal, one-on-one level. And what I'm finding is that pre-sales are pretty hard to get in most of our key markets. And the only way you can get them is through, extravagant selling approaches, which often involve offshore initiatives and the like, which are even harder, of course, in the case of things at the moment with COVID and the lack of travel and whatever. So pre-sales are hard to get. So to simply make a precondition that says, oh, our loan's subject to pre-sales is pretty much like saying, not approved, come back later. And that just puts the developer in a sort of a cycle, if you like, that doesn't sort of have an endpoint because they can't get the sales because there's no activity on site. We find they're best able to get their sales and certainly maximize their selling price when they're on site physically constructing the product, and people can then see with their own eyes that there's a project going ahead, that there's an end date, and that it's significant in nature. People believe what they see, I guess. Whereas on a pre-sales basis, look, in some markets that's a little easier, but those levels of success are volatile. They rise and fall even seasonally. The Gold Coast is an example of that. People flood into the Gold Coast after Christmas, so you can pull some pre-sales out of a shop in the high street. But other markets like Melbourne and Sydney are very wary on pre-sales because you've had instances of poorly built construction in Sydney, for example, which has put a real shadow over people buying off the plan. So we're not pre-sales focused, I guess, to make that point, Julian, and that's probably a large point of difference between us and many of our competitors.
Gotcha. And when developers are coming to you and they're sort of putting their proposals in front of you, I mean, other than the methodology and the sort of the plan, more specifically around the financials, what format are you seeing that in? I mean, Excel, Estate Master has been around for a long, long time now. Is there anything else that you're sort of seeing those applications come in?
Look, predominantly, in a simple answer, Excel, I think, is the initial go-to tool. It's a simple thing everybody can learn to do that, but it has its limitations, and it's obviously not interactive in any way. So it's just a fixed document at a point in time. It doesn't have any sort of necessary feed-in mechanisms that reach out to other information that's updated more regularly. So it's just a picture at a point in time, like a balance sheet might be, for example. You look at that and you go, okay, well, that's fair enough. But it doesn't really help you much moving forward with the project either. It really is just a snapshot in time. We've had to develop our own internal modelling, which we're constantly iterating for further improvements on, but a very, very sophisticated model that does bring in all those external inputs and aggregates them into one central source. So we do that as a lender. So we're looking at it from a lender's perspective, which is a little different to maybe a developer's perspective, because we are heavily focused on, do we have the right loan amounts? Do we have the right contingency amounts? Do we have the right allocations in the funding table? Do we have sufficient funds to complete the project? Because we'll never start a project where there's not adequate funds to complete. and we actually track back on a cost to complete basis on every monthly construction draw. So we look at the monthly construction draw that was, and we can tell a couple of things, whether it's on time or not by the dollar amount of the draw, because if it's falling behind, the dollar amounts will typically be less. Or if it's not made on time, it'll be for the same reason, because the project's late. Or the other way, if the dollar amounts are too high and above the original construction S-curve, then you go, oh, well, there's a warning sign here. Either they've accelerated the construction program through some magical way, which is hard to do on construction sites to accelerate programs, or you've got cost overruns, which is the more likely case. So we actually track that on a day-by-day, week-by-week, month-by-month basis. We'll get a formal report each month from our quantity surveyor who will attend the construction site and effectively assess what's been done over the previous month in fixtures and fittings, and report back to us in a formal written report, and we'll update our model accordingly. But the end target is to ensure that we've got sufficient cost to complete. So we'll be there right to the end with the project stakeholders to have those funds in place. And it helps with our liquidity modelling as well. So we know what the construction draws for all of our loans across the book will be on a typical month. And the program that we've developed in-house effectively aggregates all of that up. So we can aggregate it by state. We can aggregate it by portfolio manager. So an individual portfolio manager can look and see how his portfolio is traveling, and we can do it for the whole book. So they're important elements that need to be done from our side. So we're always looking for better quality products that developers might be using. So you mentioned Estate Master. It's an older school, older style product. We don't see it used that much. I think, as I said, the initial go-to is Excel, but we're interested in your product, Julian, in that sense, because I think they're the kind of big leaps in innovation that can occur, that the developers taking that up, they themselves build somewhat a competitive advantage that then by the time it's presented to us looks like a more properly made submission, like the kind of submission I was sort of talking about earlier. In our discussion, where we can look at the caliber and the integrity of that data and go, look, we can get a head around that, and therefore we can move more quickly and provide a better level of support.
Yeah, as you say, I think that transparency perspective from the lender is also important. But yeah, I mean, I promise for the audience today, there's one question on Aprao, but you mentioned it there. There's that sort of bringing in that data and helping you guys get a full picture, helping the developer themselves to create that picture and communicate it in a succinct way, giving you guys what you like. Is that the sort of the value you'd see from a product like Aprao? Like,
completely. And we've talked about that before, Julia, and we have quite a positive view about the product. We'd expect to start seeing it rolled out in application fairly soon, I guess, with some of our developer clients. But I like the interactive nature of it, the fact that you can input data from the construction site, from the project manager's office, or back at the developer's central office. And if third parties like lenders and other groups can tap into that information and can see it real time, then that's a powerful tool by any test. And particularly when you start to overlay elements of geographic sort of data management, so you're looking at locations and bringing information off Google Maps and the like, and sourcing zoning information and planning information, recent sales and sales rates and average pricing and all those things. To go and put that together in separate bits of information, it's a bit hard to tie it into one package. So I can see why your model works so well, because it collects all of that in one central spot. And as I mentioned earlier, it's interactive. And we like to be part of that process, but the project managers, the builders, the subbies, there's probably lots of contributors to that that will make a difference. And markets are dynamic, construction markets are dynamic. So the more real time that is, the more lively it is in terms of how it's updated and communicated, the better the project can be run.
Yeah, absolutely. Couldn't have said it better myself. So thank you for that. But it is interesting to see how that more transparency across the data, across the timelines, assists the lenders in aiding the developer, and also from a developer's perspective. There's no reports to be written every month. There's no sort of consistent back and forth communication that, death by 1,000 emails. It's something that's automatically there and visible to everyone at all times. So I mean, just quickly, that transparency piece and how more data, like in that visibility, like how exactly is that aiding Trilogy to make quicker and better business decisions? Is it simply just getting a full overview and then being like, yes, no, maybe, and that because you don't have to do your own research, you don't have to go out and get one of your team to look into certain things. It's just all there in front of you.
Yeah, well, I guess there's a couple of elements to the transparency question to some extent. I mean, if you go back to an essential element, is that we would expect all our clients to be transparent in their conduct and the way they approach us. And because we're getting all this real-time data in from multiple sources up and down the east coast of the country, we kind of can understand construction cost rates and sales rates and pricing and those, so we kind of know where it should be. So any lack of transparency on an applicant's part would be a real, as you mentioned earlier, red flag. We'd question that very heavily to say, well, why is there this lack of transparency? Now that can come in many forms. It can, somebody can still bring their information in elementally and say, look, I'm being transparent, but I've sort of got 100 pages of different reports here that you'll have to work through. So that's transparent, but it's not necessarily efficient. If you can convert that into an efficient, transparent process, that has to speed approval timeframes. It has to speed decision-making timeframes, not just for us, but also for the borrowers and stakeholders as well. So it can only be a good tool. And in turn, we'll always do that for our clients. We provide and our investors, most importantly, where we're quite transparent in all our dealings. We provide monthly investor reports. We communicate, the highs and lows of the month that was, and then extend that out over longer periods for quarters and annually as well. Our decision-making board members, provide a very transparent, clear direction to us as team members in Trilogy. And there's a very high focus on ethics and being in excellent conduct and a good corporate citizen at every level, and transparency is a key element of that. And I'd caution the newer developers coming into the industry that the moment you're tarred with the brush of not being transparent with your lenders and or your stakeholders is the beginning of the demise of your reputation. It is, I couldn't think of a more important thing that a developer group could have over time than for the marketplace to see them as a group that have integrity and clear speaking and honest in their dealings. So that to me is just a key success factor. So we're looking for transparency at all those levels, and the better that can be packaged and presented, the easier and quicker and better it is for all the parties involved.
Yeah, as you say, the kiss of death is when you just stop that transparency, and in the relationship business that is real estate, it really is, as you say, the start of the demise.
Yeah, and like even real estate agents, touching on that, if that's your example, I mean, people would think, oh well, they wouldn't apply to them, but of course it does. Like people, particularly developer clients, only want to use real estate agents who are reputable as well, or they should, because that's the best way to underwrite value in their project. They should definitely want a transparent and reputable lender, one that they can see a little bit behind the smoky glass in the lobby and understand what's going on in the back rooms. Do they have construction processing officers? Do they have an internal administration back house that supports the project? Or is it just a mad scramble every month to rustle up the funds for a construction draw? Well, we make ourselves quite available at every level, both to the borrower clients and also the investor groups that support Trilogy, to be as open and as clear speaking and as transparent as we can be. So, and that's helped our reputation strengthen over years, and that's what encourages repeat business. So it works at all levels of the industry, Julian.
Yeah, makes sense. So, I mean, as we get towards the end of this webinar, I mean, if we zoom out a little bit and sort of get your take on like where you see the market for 2021 and beyond, or what are some of the areas that have the most appeal in your opinion?
Yes, the $64 question. Well, look, we are all reading and seeing, and certainly Trilogy's experiences in the market on that daily basis, as I say, So we're obviously seeing strong sales activity, rising levels of confidence, and price growth. So you go, well, that's all good, and you can sort of expect that might continue for some time based on the messages that the Reserve Bank and the central banks around the world are telegraphing to the markets. There's an urge to go out and do more with your capital and release that capital. And of course, the government's and the Reserve Banks and central banks are putting capital into the market. So they're liquefying the market. So we'd expect to see, that higher level of liquidity continue on for some time yet. And that will foster all sorts of investment and development activity. And that's supported, of course, by the sales rates at the moment and the selling prices. And that's actually opened up whole new markets. So there's regional markets that were asleep up till last year that have burst into life. Like Rumpelstiltskin or something, they've all come back to life and they're now booming, thriving local ecosystems and economies, So I think some of that will stay and some of that will settle down. There'll be a balancing out once all the post-COVID lockdown exuberance sort of settles into some sort of normal pattern. But of course, all of that activity so far has led to now some pressures on the construction side of the industry. So we're hearing across all three states that trades are hard to get, materials. There's a sort of, a bit of a hesitant supply of materials in some lead areas because so much construction around the planet, really. It's not just in Australia, but through Western Europe and the US. I mean, they've all sort of burst back to life at around the same time. They've all got strong, strong investment at the moment in those areas. And all that's done is it's taken up the available resource in terms of the raw materials and the supply trades. So we sort of see that there's some volatility around construction pricing, which we're watching very carefully on a literally day-by-day basis. So both on the construction side and the value side, the market's highly dynamic. But ultimately, it needs to be underwritten by buyers and investors. And largely it's been owner-occupiers doing the heavy lifting over the last 6 months. But the investors will come back into the market as well too. And of course, so will foreign inbound investment as well, which is relatively subdued at the moment. So I think we're sort of generally, and it is the market consensus, but we're generally seeing a strong positive period ahead. But we do that with a certain vigilance and awareness of some things that could go wrong, or that could at least put blemishes on that market. And of course, having lived through multiple cycles as a company and me personally, we're conscious that nothing stays the same for long. So we're in a bit of a halcyon period at the moment. I expect that for the time being will continue. Every central bank around the world will do its level best to ensure that does continue. And so, as I say earlier, the foreseeable future, I think, is very positive, Julian.
Yeah, I mean, I think you touched on it there, where nothing really stays the same, and as we start moving forward and some of this stuff starts playing out, I guess the question is, regardless of size or revenue of a company, whether that be development or probably broadly speaking across the property industry, why do you think that, or if you do think that innovation or sort of the constant search for improvement and new processes, new technology, digitization, whatever it may be, is so important?
Well, this is probably an easy out to that question in a way, but I've not long finished my MBA, which I sort of I did through the last couple of years on a part-time basis. Look, I was quite amazed actually at how much of the MBA was focused on agility and innovation and the tactile nature of modern business in that sense. And you can only you read that in the stock markets. You can see it in the companies that are doing well. They're innovative, progressive companies. I think that's always been the case in a way, but it's the technology has this aggregator effect that the more technology is available to us, our capabilities as a society seem to rise exponentially. So I said right at the start of this talk that Trilogy's heavily invested into that. We've got whole departments of people who are focusing on our operations and our strategic direction in terms of IT and resourcing. So I think you got to be there or be out of the market. Basically, that is the only way forward, is to be agile and innovative and ultimately competitive.
Couldn't agree more. Okay, so I mean, today, conscious of everyone's time, if people want to, for the developers that are on the webinar today, if they want to get in touch with yourself or Trilogy, what's the best way to go about that?
Yep, well, we've got a 1300 number and a website, so I'd sort of direct everybody through there. We've got a very easy portal. If you hit our website, you can go straight into a portal that facilitates an online application. I'm available on LinkedIn, as are all my portfolio managers across those 3 states. And so there's multiple ways that you can contact us, and we'd like to think you get a fast and friendly level of service, but it'll be professional, and we'll have those levels of scrutiny we talked about. But ultimately, that's a healthy thing for the project. So I personally would invite, or for our portfolio manager team, any inquiries, either online or directly via the phone.
Great. Well, thank you very much for your time, Clinton, and thank you to everyone that has joined us live today as well. This is the second installment of this webinar series, and as we bring together more leaders from the development ecosystem, please reach out to us directly if you have any other topics or persons of interest that you'd like us to discuss with. But until next time, thank you very much and take care. Thank you very much, Clinton.
Thanks, Julian.
Bye for now.